The shift had started in places no headlines ever reached. It surfaced in quiet calls to accountants, in meetings where currency clauses were rewritten, in farmland visits that looked like routine diversification. Nothing felt urgent yet. The peso still mirrored the dollar. Bank doors still opened each morning. Statements still carried numbers that appeared exact and dependable. Stability felt ordinary, and that ordinariness was its strongest disguise. For years, parity had been repeated as certainty. 1 peso, $1. The symmetry shaped pricing, salaries, mortgages, even expectations about the future. Middle-class households organized their lives around that promise, believing the cycle of volatility had finally been broken. Political rhetoric reinforced the narrative, presenting the exchange rate not as policy, but as achievement. Beneath that surface, the mechanism was fragile. Maintaining parity required a steady inflow of dollars. When exports slowed, debt bridged the gap, converting tomorrow's obligations into today's calm. Bond issuances extended the illusion incrementally, allowing stability to persist without resolving its structural dependency. To most families, it felt like modernization. To the financial system, it felt like a corridor, narrowing with each step. By the late 1990s, pressure accumulated quietly. Regional devaluations redirected capital, tax revenues softened, and interest payments hardened into fixed commitments. The state could not create the dollars required to sustain the peg, yet the economy demanded them to function. The imbalance settled into balance sheets rarely examined outside policy circles. Depositors saw intact balances and assumed liquidity. That assumption became the system's final layer of comfort. Bank assets existed, but often as loans to a government constrained by the same currency limitation or bonds denominated in units it could not issue. The architecture functioned only as long as confidence remained uninterrupted. Liquidity was less a reserve than a belief extended through time. Time began to contract as the year approached its end. Withdrawals increased subtly at first, a few additional percentage points each week. Companies shifted operating cash abroad, families wired savings to relatives in foreign cities. Under the guise of precaution, official data lagged behind behavior, and by the moment, authorities acknowledged outflows. The available dollars inside the system were already spoken for. Well before the freeze, some wealthy families had made a different move. They did not rush to hoard gold or empty accounts overnight. Instead, they migrated wealth into assets linked to external pricing and beyond immediate domestic restriction. Agricultural land, export-exposed businesses, and offshore accounts became quiet anchors. The strategy did not signal panic. It resembled prudent allocation. Only later would its timing appear decisive. The withdrawal restrictions arrived framed as temporary stabilization. In practice, they revealed something deeper. The money depositors believed they possessed had been transformed into illiquid claims shaped by policy. Access became conditional. Ownership shifted from a number displayed on paper to a permission granted in increments. Those fully dependent on the domestic system experienced the change as rupture. Salaries continued to appear electronically, but cash grew scarce. Retailers preferred physical notes, and informal exchange counters emerged, quoting rates that drifted steadily away from the official one. Economic life split into parallel realities, one recorded, one negotiated in whispers. Asset distinctions suddenly mattered. Pasadena-mated savings accounts remained numerically stable, yet lost immediacy as stores of value. Purchasing power became speculative, tied to expectations rather than present exchange. Meanwhile, assets existing outside the banking grid retained continuity. Physical currency, land, and durable goods functioned without requiring institutional permission. Agricultural land revealed a particular resilience. Its valuation derived implicitly from global commodities rather than domestic policy. Crops sold into international markets generated dollar revenues independent of local controls. Families who had accumulated farmland years earlier found insulation not merely from foresight, but from structural linkage between soil and external currency flows. Urban property behaved differently, yet still offered partial refuge. While not export-generating, it carried embedded scarcity. Sellers hesitated, buyers appeared with cash, held outside banks, and value migrated from official listings to private negotiations conducted beyond formal frameworks. For wage earners and smaller savers, the timeline compressed abruptly. Their wealth existed largely as institutional claims with diminishing flexibility. When authorities converted dollar deposits into pesos at a mandated rate, losses became immediate in numerical terms. Psychologically, the loss had begun earlier. The moment withdrawal limits redefined the meaning of access. Trust eroded faster than balances. Policy responses oscillated between reassurance and urgency. Decrees altered contracts, tightened exchange controls, and attempted to stabilize expectations while inadvertently confirming fragility. Each new rule highlighted the distance from the original promise of parity. The guarantee that once felt permanent now appeared provisional. Outside official channels, adaptation unfolded rapidly. Transportation fares adjusted informally. Rental agreements incorporated alternative reference units, and imported goods repriced with increasing frequency. A shadow exchange rate shaped expectations even when public acknowledgement remained restricted. Economic activity bifurcated into what regulations prescribed and what survival required. Banks remained open physically, yet transformed functionally. Lines formed not for large withdrawals, but for the small weekly allowances permitted under restrictions. Waiting replaced planning. The relationship between depositor and institution shifted from contractual certainty to procedural negotiation, redefining the emotional texture of saving. The state's restructuring of obligations intensified redistribution. Domestic dollar debts were converted into peso liabilities, and the chosen conversion rate determined outcomes with mathematical precision. Balance sheets recalibrated overnight, transferring purchasing power through administrative decision rather than market dynamics. Those with external holdings bypassed the conversion entirely. Their units of value persisted unchanged, offering continuity in both numbers and planning horizons. The advantage was temporal as much as financial. They avoided renegotiating their relationship with the currency because their wealth had already been denominated elsewhere. Public unrest followed, driven not solely by scarcity, but by the realization that values governing rules could change without consent. Supermarket shelves emptied as households rushed to exchange fragile balances for tangible goods. Consumption became defense, an attempt to anchor purchasing power before further erosion. Within months, the peg collapsed. The peso floated and depreciated sharply, forcing prices to realign with the new exchange reality. Dollar debts grew heavier for those earning locally, while borrowers able to repay in devalued currency experienced relief. Agreements forged under one assumption concluded under another, reshaping financial trajectories unpredictably. Exporters experienced a different outcome. Revenues earned in dollars multiplied when translated into the weakened currency, amplifying local purchasing power. Agricultural land values rose accordingly, revealing that allocations once perceived as conservative or traditional carried structural advantage in a devaluation environment. Urban middle-class savers confronted the inverse path. Converted deposits lost purchasing power steadily, dissolving the symmetry that had underpinned a decade of planning. Retirement calculations blurred, long-term projections shortened, and the past's numerical stability no longer mapped onto present material reality. Although banks eventually resumed normal operations, behavioral change endured. Cash usage remained elevated, informal dollar holdings became commonplace, and memories of restricted access embedded themselves into collective financial psychology. Preferences shifted toward assets perceived as independent from domestic policy intervention. In retrospect, the collapse appears sudden because its visible phase condensed into weeks. The underlying process unfolded gradually through fiscal constraints, refinancing cycles, and confidence sustained by assumption rather than capacity. Stability had been continuously negotiated rather than definitively secured. The withdrawal freeze did not create fragility. It exposed the boundary of available liquidity. Once demands exceeded reserves, authorities faced a binary choice between depletion and suspension. The decision to suspend converted a technical imbalance into a social fracture, altering perceptions of security more profoundly than any statistic. Differences in outcome were shaped less by superior intelligence than by asset structure and jurisdiction. Wealth embedded within domestic institutions became subject to domestic resolution mechanisms. Wealth connected to external pricing systems retained autonomy, insulated from policy adjustments enacted within national boundaries. Recovery eventually appeared in macroeconomic data. Output rebounded, exports expanded, and new frameworks replaced the rigid peg. On paper, growth resumed. Beneath that recovery, however, a reordered hierarchy of trust persisted. Financial behavior adapted to an implicit understanding that convertibility could never again be assumed absolute. The image of restricted access endured as a reference point for future decisions. Even after queues vanished, transactions carried the memory of limits, influencing asset choices and diversification strategies across generations. Stability was no longer interpreted as permanence, but as a phase contingent on policy alignment. Somewhere between belief in parity and acceptance of devaluation, a pattern emerged. The crucial distinction was not the ability to forecast exact timing, but to recognize which forms of wealth relied on continuous institutional permission and which maintained continuity independent of it. That realization unfolded quietly, visible only when paper balances and tangible goods began moving at divergent speeds. In that divergence, the hierarchy of assets revealed itself. Wealth anchored to external demand, real production, or jurisdictions beyond immediate policy reach retained coherence. Wealth confined to domestic promises encountered renegotiation. The lesson did not arrive as a prediction fulfilled, but as a structure exposed. Demonstrating that stability had always been conditional, negotiated in real time rather than guaranteed in principle.